So we reviewed the equity markets. We have volatility back. Valuations are slightly elevated. We've looked at the fixed income markets. Again, we're not getting paid for taking credit risk. We want to stay short. We want to stay defensive. So obviously the big question is, what do we do with our money? Well, obviously we're selective in our equities. We're defensive in our fixed income. Where is the opportunity in a market with volatility like this? And the answer is alternative investments. Over the last several years, alternative investments have really been pushed aside. And that makes sense. When the stock market's running, everybody just wants to get long into stocks and ride that wave. Again, buy low, sell high are a consistent theme. What happens in hot markets, the money runs to the market late just as the market's ready to turn over. Now, we're not saying that's going to happen this week or this month or even this year, but now's the time to start positioning the portfolio for more volatility, more equity, and more events. And the way you do that is hedge. Put it in an asset that's not correlated to the asset you own. That's alternative investments. If we go back in history and we look at years like 2002, in years like 2008, nobody wanted alternative investments. They were busy buying stocks in a hot market. When did they want those alternative investments? They wanted them in 2004, they wanted them in 2003, they wanted them in 2009 and 2010 after the market crashed, and they looked back and said, wow, these things protected portfolios. I wish I had them, I'll buy them now. So our advice is, let's look at them now, today, rather than look back and say, I wish I had. Traditionally, your diversified portfolio, the 60-40 stocks and bonds or 50-50 stocks and bonds, is built around the concept that when stocks go down, bonds do well. When bonds go down, stocks do well. So let's diversify. Well, the question today is, are bonds really a hedge for stocks? And this chart shows that over the years, when we see these big movements in the stock market down, bonds actually do quite well. Take a look at the 2000 bear market. Take a look at the 2008 bear market, and you'll see bonds are up when we see these big dips in stocks. But this time, is that going to hold? And in the first quarter of this year, thus far it has not. Stocks were down and bonds were down. So what we have to bring back into the equation is a 37-year bull market in bonds is reversing. There are so many people who have never invested in a bond bear market, a secular bond bear market. And so if this is going to start, can we definitely rely on the fixed income? Our answer is we don't think so. So what do? Well, the term hedging a portfolio is the genesis of the term a hedge fund. And so bringing in hedge funds to a portfolio, in fact, lowers the volatility and enhances returns over just a stock and bond portfolio. Let's take a look at this chart. So as we look at the chart and we see the orange-yellow line is equity, the red line is your traditional 60-40 stock and bond, and that black line is 60-15 bond and 25% in hedge funds. And let's look at the result here. There's actually only 2 points in time since 1989 where 100% equities beats our hedge fund, fixed income, and stock portfolio. Now this goes against what everybody believes. Just put it in stocks and go to sleep and don't sell it and you'll be fine. Well, that only actually holds true at the very top of a bull market. And in fact, as we look in 2000, the top of the tech bubble, equities just got above this blended portfolio, and they're today just getting above. The rest of the time, because these portfolios hold up so well in downturns and still give us upside in normal markets, in fact, it runs right in parallel with the equity markets. It spends most of its time above 100% equity portfolio. But the key here is it does it with less risk and less volatility. So when is a good time to buy hedge funds? When markets are high. When that orange line gets above, that means hedge funds are at attractive prices. So we have always been a proponent of hedging strategies. Right now it looks particularly important to make sure we have those in your portfolio. Additionally, another way to hedge a portfolio is to take out the market volatility. One of the challenges of investing in public equity is you constantly have this day by day, minute by minute, nanosecond by nanosecond movement in price. And we're already starting to see it. We just wrote a white paper here about a month ago on algorithmic trading and these shock events that happen in the market that You're looking at the market, it's down 200, and then you blink your eye and it's down 1,600. So these events are only going to increase with frequency as more and more speed trading comes into the market, algorithmic, computer-driven trading. And so what do? Well, one thing we can do is take our money out of the market. Private equity, another form of alternative investments, to us looks very attractive. Historically, private equity delivers higher returns than the stock market with lower volatility because it's not in the public markets. Now, this isn't for everyone, mainly because private equity is also illiquid. We have to put money in that we can lock up for years, 5 years, 7 years, 10 years. And so what we demand is an illiquidity premium of return. We want a higher return, we want lower volatility. It's not less risk, it's just less movement. So looking today and saying, is now an interesting time to buy private equity? Let's look at valuations. This chart shows since 2011, the valuation for the US public markets, the US private markets, and then also Europe's public and private. Well, as we'll see in 2011, the valuations were pretty close. Fast forward to today, and what we'll see is the US market, here's that stock run. Look at the valuations. They've jumped, and private equity has stayed relatively consistent on a valuation basis. As we look at Europe, that's also stayed relatively consistent on the private side, but the public side has now jumped up, and the public valuations are slightly higher than private. So going back to our themes, find better valuation, that's in the private markets. That gives us diversification, it gives us return potential, and it lowers the equity market volatility in our portfolio. Additionally, we're looking for hedges for income. We still want to generate income in a portfolio. So if in our fixed income portfolio, we're being defensive and we're pulling back and we're not taking the risk to grab a couple extra points for high yield or get a couple extra percentage points for a 20-year bond versus a 2-year bond, well, we have to find income somewhere. Again, let's go to the private equity markets. There are private equity ventures that strictly deal in debt. And they get payments, they get income and interest payments just like other forms of debt, but they go into markets that are not normally the purview of the public markets. And so as we look at this chart, we'll see the bottom chart, the bottom line is the 10-year Treasury, and the blue line is high yield, and then the top is what's called second lien debt. So these are somewhat more aggressive debts. They are not in the public eye, but they pay very high rates of return. And so that's that illiquidity premium. If we look at the gap between the blue line and the gray, that's the illiquidity premium. Now, as we'll see in 2008, when the markets crashed, these numbers went through the roof just as high yield did. The difference is they weren't marked to the market every second of every day. So when we look at opportunities for income, if we can find managers that do this every day, that know their private credit markets, and can give us a high-quality portfolio with an illiquidity premium on interest rates, that's definitely something we want to put a piece of our portfolio in. Now, like everything else, you can't overdo any one thing. No matter how high the potential rate of return is or how big the illiquidity premium is, this is illiquid. We want to put the right amount of money in these different endeavors, but we also think these are attractive diversification vehicles that will enhance our return over time.